In mid-2026, Netflix stock dropped an aggressive 44%, dragging the share price down to exactly $73.81. The panic was loud. Headlines focused on a 10-for-1 stock split, which simply divides existing shares into smaller pieces without changing the actual value of the business, and the sudden departure of co-founder Reed Hastings from the board. But if we step away from the flashing red screens of the stock market, we find a very different physical reality. Over 325 million people pay for this service every single month. It generates tens of billions of dollars in actual cash. To understand what is happening here, we have to separate the emotional price tag the market assigns to a stock from the mathematical reality of the product itself. Let's ignore the red price tag for a few minutes and look under the hood of the business machine. A common worry among investors is that almost everyone in the US and Canada who wants an account already has one. If new signups slow down in those mature markets, how does the business keep growing? Netflix built a specific structural solution to this problem, a massive expansion into digital advertising. This chart shows the scale of that new audience. By offering a cheaper plan, they brought in a wave of price-sensitive viewers who weren't previously paying for the service. Today, 250 million people watch this ad-supported tier every single month. The math here might surprise you. In the US, a user paying $8.99 a month for the ad tier actually generates more total cash for the company than the old ad-free basic plans. The subscription fee plus the advertising revenue stacks up to a higher total yield per person. They are now using automated bidding technology to sell those commercial spots instantly to thousands of brands, driving toward a target of $3 billion in ad revenue for 2026. The result is a highly profitable digital advertising platform operating quietly inside a streaming app. So why did Wall Street panic? The main trigger was a reported drop in the company's first quarter free cash flow, meaning the actual cash left in the bank after paying the bills. To understand why this isn't a flaw, we need to look at an accounting rule called amortization. Think of it like buying a house in cash. When you buy the house, your bank account drops, but your actual wealth hasn't disappeared. You simply traded cash for a physical asset that holds value. Netflix is doing exactly the same thing. They are spending roughly $20 billion in cash this year, heavily weighted in the first 6 months, to build a vast library of content. They are trading cash today for assets that will keep people watching tomorrow. A big chunk of that cash is securing things you have to watch live. For example, they acquired the rights to broadcast WWE wrestling matches to guarantee huge audiences tuning in at exactly the same time. They are applying the exact same strategy to premium live boxing events. That dip in quarterly cash flow is a deliberate self-funded investment. They are spending their own money to lock in future attention. The management team is also fiercely protective of that cash. Recently, they found themselves in a bidding war to buy Warner Brothers Discovery's. When the price got too high, they walked away. Because they walked away, they collected a massive $2.8 billion breakup fee. They immediately turned around and authorized a $32 billion program to buy back their own stock, permanently reducing the number of shares and making every remaining share more valuable. This discipline highlights how Netflix has decoupled from traditional media. While competitors like Disney are struggling with billions in debt and shrinking cable networks, Netflix is generating enough cash to buy back 10% of its own shares. The real competitor for your attention is free, built by creators, and lives on your phone and television. This pie chart shows total TV viewing time in the United States. You can see YouTube clearly dominating with a 12.5% slice of human attention, maintaining a firm lead over Netflix at 9%. The battle going forward is a fight for total screen time against massive free platforms, which brings us back exactly to where we started, the $73.81 price tag hanging on the stock today. That price means the market is currently valuing Netflix at about 20 times its expected earnings, its lowest valuation in years. At the same time, the company is hitting 32% profit margins and doubling its ad business. If the business simply continues to generate its current level of cash and the market returns to a standard valuation for a high-growth tech platform, the math points to a fair value between $100 and $130 per share. Short-term market fear has created a steep discount. When the crowd panics over headlines, patient investors look past the price tag and buy the product.